Our philosophy is if you see a super spike in oil, wait for it to drop 20%, and then it's all but guaranteed to really collapse from there. And so buy out of the money puts at that point. Non-investment advice, yada, yada, yada. Far better to do that than to try and time a crisis.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with our resident energy expert, Doomberg. In today's discussion, we're going to talk about gold, nuclear energy, oil, natural gas, and geopolitics. We'll also discuss the recent fire at the Chevron refinery and how that will affect you. Doomberg, thank you for coming back on the show.
Steve, always a pleasure to see you. Looking dapper as always.
Thank you, sir. Thank you, sir. I also have my new bit of swag here, my Doomberg coffee cup. So a little shout out to your storefront there. It's pretty cool.
Aren't you nice? That's a great mug. Coffee tastes better out of that mug for some reason. That's what we're told.
It does, don't it? It's one of my few addictions, but I just can't give up coffee, and this has become my new favorite cup. I like how you use the little eyes to do the double O's in Doomberg. That's pretty cool.
Yeah, it's a great design.
Yes. Okay, let's kick it off like we always do. Macro view. What's on your mind today?
Well, obviously, we always start with energy. Energy markets are still very well supplied. Oil in the low 60s, landed LNG in Europe at $11 a million BTU. Natural gas costs you a medium Diet Coke for a million BTUs in the US. Coal is behaving rather normally. Not much to see in the physical markets. That's usually relatively bullish for macroeconomics. Cheap energy is a great foundation for economic growth. And then the pair trades that we look at to be early indicators of potential crisis aren't signaling anything significant. And so, when we look at landed LNG versus Brent crude, they're trading in harmony with each other. When we look at WTI and Brent, nothing crazy there. There's a few other pair trades we look at. Obviously, the gold situation is top of mind for us. I know we're going to talk about that. Geopolitics, developing situation in Europe. We're writing on that later this week. I'm sure we'll get into that as well. The war in Ukraine is grinding towards its inevitable conclusion, and NATO and the European Union are about to enter a very rough patch, in our view. And then the BRICS countries continue their march as well. We note with interest that Trump spoke with Lula today of Brazil. And so there's so much to talk about, Steve. Happy to take it in any direction that you would like.
Okay, so as far as looking at the price of energy, it's doing nothing but flatlining or getting cheaper. So that's not forecasting any kind of global event that you can see from there. We're going to get into some geopolitics and Macron. And well, let's start off with gold. You alluded to that. Just kind of go your macro thoughts on gold, and then we'll get into listener questions. What do you see today with gold?
Sure. Gold is behaving as though the BRICS countries in particular are reinstating gold as a neutral reserve asset for the settlement of imbalances in international trade. In order for gold to effectively play that role, it needs to be much higher. The U.S. has an interest in perhaps gold getting higher as well, because that allows Secretary of the Treasury Scott Bessent to revalue the gold holdings, in theory at least, which would make his job of refinancing the wall of short-term debt that his predecessor, Janet Yellen, left him comparatively easier. Not easy, but easier. And, every day I wake up and it's up 50, 60 bucks an ounce. It's been an incredible run. It's tripled from when I first started using Fizz as a savings vehicle in scale. But that's another way of saying it, of course, is that it takes 3 times as many US dollars to buy an ounce of gold now than it did back then, which is the primary purpose of gold. It's an interesting market. It's kind of just grinding higher and higher. And if you price commodities in ounces of gold, our preferred measure of the relative cost of commodities, the long-term real price of all commodities is lower. So when you say oil is flatlining, it's flatlining in an inflationary environment that is still above the Fed's target rate. And so it's not really flatlining. It's going down in real terms. And so this is why, of course, we avoid investing in commodities directly or producers of commodities as a general rule. Gold not being a commodity, gold being the center of the financial universe. Yeah, gold is fascinating to watch. It's a bit unnerving, if we're being honest, because the vast majority of my personal net worth, for example, is in non-gold US dollar denominated assets, some of which do well in inflationary times, of course, but it's still, when gold moves too quickly, it's a bit unsettling. Silver has been interesting to watch. We have no position and no real strong opinion, but silver trades with significantly more volatility typically than gold. So, and then Bitcoin's on fire today too. We note with interest, to the extent that Bitcoin is itself an inverse judgment of the U.S. dollar. That's a data point that we watch. And so, I think long term for the U.S. to have a manufacturing renaissance of the form that Trump is angling for, the U.S. dollar needs to be much weaker, not just against the currencies of the other G7 countries, but against gold as well. So lots of momentum, lots of tailwinds for gold. It's moved a lot, so it's not like I feel comfortable going out and buying more. Not necessarily feel comfortable selling any that I have. So it's how that goes.
Okay, I'm going to emphasize your point here with a little screen share here, and this is dividing crude oil by gold. Okay, so basically, as the chart goes down, that means that oil is getting cheaper in relation to gold, and this point of reference right here, this will be the COVID crash when oil got negative. So just
Yeah.
emphasizing your point here, oil is definitely getting cheap in terms of real money. You mentioned Scott Bessent. He wants to revalue gold higher. What?
So there's a bit of a trick of accounting, which is sort of a backdoor QE is the way we would think about it. Um, Fun fact of history is that the U.S. government on the government's balance sheet marks its substantial gold holdings, assuming they're there, at $42 an ounce. And if they were just to market, the U.S. would have $1 trillion worth of gold, which apparently frees up Bessent because of some quirk in the law to effectively print that money outside of the purview of the Fed. I'm sure I'm getting some technicality wrong, but that's the nuts and bolts of it. It would give $1 trillion worth of flexibility to Bessent. And if they just decide that they're going to remarket at 10,000 an ounce, because they could pick whatever price they want, kind of like analogous to printing the $1 trillion palladium coin, you remember, or
Yeah,
platinum coin, when they were going to do that a couple of years ago.
yeah,
It's effectively just creating money out of thin air in a way, because they're not proposing to sell the gold to get that $1 trillion. It just gives the Treasury some degree of flexibility, apparently. Who knows? I mean, the mechanics of how the U.S. federal government decides to hyperinflate away and debase the U.S. dollar is not as interesting as the net effect of it. The net effect of revaluing gold is probably very bullish for gold and stocks and Bitcoin, as our friend Luke Roman has been pounding the table on in his weekly newsletter, Tree Rings, for some time. And so that's the issue there. Like, if per the U.S. government, the millions of ounces of gold that the U.S. government owns is marked at $42 an ounce. So it's 1/100th of the current price, plus or minus, to the nearest order of magnitude. But the thought is, if they remarket at 12,000, that's 3 trillion. If they remarket at 20,000, that's 5 trillion. We're in end stage stuff when we're talking about this. Like, there's no talk about fiscal discipline, cutting spending, balancing the budget, hard currency. No, we're just talking about tricks and acronyms that all end up doing the same thing. They inflate risk assets in nominal terms. You hope that your risk assets inflate faster than debasement. By definition, not all of them can. And so it's a tricky time to try and front run a grinding debasement of the currency.
yeah, yeah. That's what we're all trying to do, is just outpace inflation and make a little on top. I just realized the risk of having a calendar over your left shoulder is that you forget to flip it when you're actually recording. So we're actually recording here on the 6th.
Well, why don't you take a
not the
second and
4th.
flip it now?
Yeah, okay. We will make this one accurate now from here on out. This was the last time I recorded, was on the 4th. And now we are
There you go.
date.
My
There we
my
go.
bad my bad for not noticing it.
Mine too. I think that's the second time I've forgotten to do that, but most of the time it's spot on. Okay, James has a question in relation to gold. He says, if the recent investment by stablecoins into physical gold and gold royalty companies, and the likely increase they likely increase significantly. How do you see this affecting gold price volatility going forward? And should we start to look at gold in a significantly different way now?
Yeah, I don't know how it would affect volatility that much. Stable coins have stable in the name after all. Um, but, it's bullish, all things being equal for gold. Any incremental bid from an industry with a growing amount of assets to put to work is, all things being equal, bullish for gold. The gold trade is just now kind of escaping the gold bug and slowly beginning to get into the mainstream community. So from the gold bug community, like you and I, who owned gold for a long time and have been worried about debt, 20 trillion ago, um, it's it's just now becoming sort of mainstream. It's still highly underowned in the West, not so much in the rest of the world. Huge demand for gold in China and India and global South, and fascinating to plot the price of gold and other currencies. If you were in Argentina, you probably wish you'd owned gold. Several orders of magnitude of debasement ago. We're running an uncontrolled experiment. The world's reserve currency is debasing at an accelerating rate. And we've never really seen this before, I guess, Rome, but in modern times. And who knows how it's going to end. Like I've one disappointment, like many disappointments with Trump, some very positive things. Obviously, every politician is a mixed bag, but the utter failure of Doge and Trump's inability to significantly cut government spending is, I think, disappointing, to say the least.
Okay. It probably isn't going to contribute any real volatility, but it is money coming into the sector, and it's just evidence that governments are printing away, and that's kind of a way to measure it.
Yeah, I mean, if they were day trading gold and swinging in and out of it to meet redemptions and stuff, then that would be a different story. But I mean, stablecoins generally just accrue assets now, especially that they have the full weight of the U.S. government in support of their creation and existence. A complete whiplash from the prior SEC. And of course, stablecoins are related to the gold revaluation question because our view, and it's a popular one, is that the U.S. government is encouraging the growth of stablecoins and speculation in cryptocurrencies and things like Bitcoin in order to create a steady demand for short-term treasuries, because with the passage of the Genius Act, stablecoin operators must hold U.S. treasuries. There's even a world that we can envision where the government issues stablecoin treasuries for stablecoin operators that pay a lower rate. It's just a form of financial repression at some point. If your costs are basically nothing and you're going to get 2% yield instead of 2% is still greater than zero, and there'll still be plenty of people willing to do it. And so this is in the long term, nothing more than a debt management strategy masquerading as a risk asset class.
Yeah, I remember we talked about that. I don't remember if it was the last time we interviewed or the one before, but you're basically saying that what they'll do is with these stable coins, they'll say, hey, instead of us just storing it in cash, we're going to be storing this in 1 month treasuries. That will create demand for treasuries, but then the Treasury Department will say, yeah, we know the going rate is 4, but we're going to give you 2. And that's the law, so take it or leave it.
Correct.
Okay. All right. Okay. When you first told me that, I was like, oh my God. I have no argument to the other side. That's got to be what they're doing. You know?
Well, we like to develop mental models as we do lateral brainstorming, and at the beginning of the Trump administration, one of them that we used, these models need not be right. You don't care if they're wrong. They just make you think interestingly. One of our mental models was the greatest crisis facing the Trump administration is the wall of debt that was left behind by Janet Yellen. And then when you reframe the behavior of the administration through that lens, patterns tend to emerge and things tend to make sense.
I've been talking about this with my premium subscribers. Why do you think that Janet Yellen didn't put the debt out 30 years? Was there no demand for it, or was this, by design that she just did short duration debt and that's coming due now instead of kicking the can another 30 years down the road? What are your thoughts on that?
I think, honestly, I am very cynical about Janet Yellen and Jerome Powell. All of Washington, D.C. was doing everything it could to get President Biden over the line and to keep President Trump out of office. I just think objectively, a nonpartisan observation. And especially after the election was over, I think they just, you know, did everything they could to leave a bag of you know what in their wake. There was no put the country first patriotism in D.C. This is a bipartisan issue. But last year, for example, if you would have said, when will Jerome Powell start cutting rates? I would have said, right, just before the election. Like, it's plainly obvious. It's a political organization. And Janet Yellen emptied every short-term juice the market tool at her disposal in order to prop up the economy, prop up stocks, and prop up Joe Biden's chances for reelection. And so there was no country patriotism. That's long gone on both sides, of course. But Janet Yellen in particular was very skilled at leaving a crisis for Scott Bessent. And someday when Bessent writes his biography, I'll be keenly interested to read that chapter.
Yeah. Okay. All right. Okay, moving on to oil and energy. Jay wants to know, so you touched on it in your intro, but what is your short-term and long-term outlook for oil?
Lower. I mean,
Yeah.
I know I sound like a broken record. Look, um, people get seduced into buying oil because sometimes it spikes really high, because sometimes there's a crisis that blocks a key choke point or blows up some, tankers or and the price of oil spikes, and people get seduced to trying to catch that spike on the way up. Our view is you should just try to catch them on the way down. That way, at least you know one is happening, and you're not sort of like it's like buying vol. You're just burning away premium, waiting for the spike that doesn't come. And so our philosophy is, if you see a super spike in oil, wait for it to drop 20%, and then it's all but guaranteed to really collapse from there. And so buy out of the money puts at that point, non-investment advice, yada yada yada. Far better to do that than to try and time a crisis. And because the oil and gas companies are the real technology sector in the economy, they're technological powerhouses. They are deflationary machines. There's, in our view, an infinite supply of hydrocarbons underground for modeling purposes, and they're getting better and better and better and better and better at finding those hydrocarbons and bringing them up to the surface. So, natural gas in Appalachia, break-even drilling cost is like 210, 215, 225 a million BTU right now. That's the oil equivalent of $12 or $13 a barrel. China is converting coal to diesel and other chemicals on a huge scale now. I saw a report in Bloomberg and something we're researching for a piece. Javier Blas said that if China's coal to chemicals were a country, it would be the second largest consumer of coal in the world. So you're seeing molecular switching to replace oil with natural gas liquids, natural gas, and coal. And we're seeing engine switching to run the engines on different hydrocarbons as they become cheap and available. And all of this is putting a lid on the price of oil. On top of that, you have huge supply growth in Guyana. You have huge supply growth in Argentina, assuming that doesn't devolve into yet another basket case. You have Venezuela, potential regime change, which could unlock huge supply growth there. You have Mexico, we're publishing on tomorrow, a mess. The cartels have destroyed the national oil company there and put the country in a real dangerous position. If that ever got sorted out, Mexico could double its oil production relatively easily with U.S. technology and U.S. help. So, and of course, we have OPEC increasing production. And so, oil is the equilibrium price of oil is $55 and going lower. And so there's a slight premium in the markets. That's fine. Nothing tradable in our view, but nothing about sort of the price supply demand dynamics of oil gets us all that excited.
Okay. So generally speaking, you still believe what we talked about last time that these companies are deflationary machines and they're getting better and better at extracting it out of the ground and delivering it to us. And so that would go in line with it's going to continue to get cheaper.
Yeah, and we put a whole piece out about just how much natural gas there is in the U.S., for example, and it's we have so much gas in the U.S. and all these market analysts talking about share rolling over, and it's just trying to be as polite as I can. It's just so incongruent with what we see and hear from our industrial contacts. We published a piece called Shale Gas Arithmetic, and there's a pinned comment. Now, only paid subscribers can read our comments, but everybody listening should be paid subscribers at Doomberg, we hope. The pinned comment, this geologist with huge experience in the natural gas sector wrote up basically an essay on just how much gas there is in the U.S. and how we're swimming it. Take the Permian, 0 to 20 BCF per day in 15 years without even trying. And there's huge non-shale resources in the Permian that could be tapped. It's just not economic to do so when natural gas is trading for negative prices, right? If there was a national global floor price of $5 a million BTU, the production of natural gas in this country would explode to huge levels. And it's just too much of it. Like we're drowning in it. And so this is, because it's co-produced with oil, by the way, this is another factor. So if a $5 a million BTU floor price would be put on natural gas, which is, let's say $30 a gallon of oil, still pretty cheap, they'd be giving away oil in the Permian as a nuisance byproduct instead of natural gas. And then suddenly that is the headwind for oil because they're co-produced. So I've competed against co-producers. Like when you are a pure play producer, there's nothing worse in your market than a co-producer because there's an entire market that can affect yours beyond your control. So broadly speaking, Appalachia is pure play natural gas. Permian, other shales are co-produced. And so when natural gas prices really sunk, you saw the curtailment happening in the pure play gas fields, not in the co-production fields. Well, if natural gas were to skyrocket because, say, AI demand materializes and we see all these data centers going in the Permian and it just goes to $3 or $4 or $5 a million BTU, there's a whole fallacy of thinking, what is the break-even price of oil in the Permian? Well, you can't just look at the price of oil. You have to look at the price of oil and the price of gas because they're co-produced. So the break-even price of oil could go to zero in the Permian with the right natural gas price. This is a fundamental change in the energy markets that very few people articulate or have worked into their models. And that's because the shale revolution brought with it the co-production of the two molecules and NGLs in the middle. And there's just a wave of these new hydrocarbons coming to the market. We read with interest on RBN Energy this morning. Ethylene exports look like they're going to double because now there's some new infrastructure being built, which is an outlet for one of the NGLs, the lightest of the NGLs, which allows for more drilling in the Permian because now they have a place to put the stuff. We have these choke points. Understanding what they are and how they're relieved will give you a very good indication of market dynamics. But that's what we do. That's why we have the audience that we do, and we're very strong in our conviction that we are swimming in hydrocarbons, and you don't really want to be long the producers of it.
Okay, and basically, you have to look at both of them together because as one becomes more plentiful, that will make it cheaper, which will make the other one a little bit more expensive. Vice versa, they're both hydrocarbons,
Sure.
and people will change their engines to run on whatever is the cheapest.
Right. Let me give you a counter narrative, or a narrative consistent with that hypothesis. So OPEC is a cartel, and OPEC has been keeping the price of oil artificially high. That's what cartels do. Okay. The price of oil being artificially high has triggered drilling in the Permian, which brings with it this bounty of natural gas. Well, this cheap natural gas then gets turned into oil products or used in applications where engines that burn oil had previously held share. That becomes the undoing of OPEC's own market. Because it's co-produced in the Permian at scale, keeping the price of oil high means that the price of natural gas drillers could accept is much lower because they have this premium that they're capturing when they sell their oil. And then there's all this cheap natural gas. Well, energy arbitrage is powerful. Entrepreneurs do their thing. Hey, I've got an engine that burns natural gas, where all you have to do is just switch it out and it's cheap, and then you're basically getting free fuel. Well, if you're driving a tractor or a dump truck and somebody offers you free fuel, you're going to take it, and it doesn't take much in the way of switching to impact demand. And so OPEC, in its own sort of perverse way, has been catalyzing its own undoing by keeping the price of oil artificially high. And so, because again, when oil was a pure play and there were no co-producers, you could almost get away with that. But now that there's co-production and substitution going on, that's every engine that's switched is one that's gone for a very long time.
Yeah. Okay. Interesting. I'm excited to see how that plays out. um, okay. Is only for entertainment wants to know, like the screen name. If the United States takes over Venezuela and retains Argentina, what does that do for the price of oil and gas? WTI especially is $55 per barrel still is call. Yeah, so that is.
Yeah. Yeah. I mean, again, take Argentina. Um, Vaca Muerta. Um, we did a piece on this called Cash Cow. Um, in a stable country, which Argentina unquestionably is not, um, that resource is every bit as attractive as the Permian. Some say even more so. It's sitting there. They're just now getting the critical mass. One of the things we wrote in a piece called Blooming Flower is once you have a critical mass of majors in an area, they tend to like spread out and develop other resources because they have the midstream and service providers there with them. You need a roaming critical mass of capital and engineers and expertise. Once you set up shop in Guyana, boy, our Venezuela next door looks pretty attractive, right? And Chevron's in Venezuela already, but you have Exxon and you have Chevron next door in Guyana, and you have all the majors there, and it took an enormous amount to set all that up, but now it's there, and so suddenly you see Trinidad and Tobago sign a deal with ExxonMobil to develop its oil and gas resources, a country that has always punched above its weight in the LNG markets, has a lot of hydrocarbon resources right off the coast of Venezuela. So if you could stabilize Argentina, you could get to multiple millions of barrels of oil a day under Malay. And Venezuela used to produce 4 million barrels a day. It has a resource every bit as good as Canada, slightly different chemistry and geology, but there's no reason why Venezuela couldn't produce 5 million barrels a day of oil. They produce one today. Um, and if you take the best of American technology and deploy them against these resources, the sky's the limit, of course. So all of this is deflationary for the price of oil. It's wonderful for companies that are leveraged to the volume of oil produced and sold, not necessarily the price. And so this is why if we were forced to invest in the sector, we would be interested in things that unlock volume, services, midstreamers. We have a special catalyst that we sell to refiners, or pick your favorite enabling technologies that enable volume. That's interesting to us, much more so than just the commodity itself or the producers of that commodity.
Okay, so Vaca Muerta, instead of calling it the dead cow, you're calling it the cash cow. If that
Correct.
truly gets unlocked, that could be more deflationary for oil. And let's see, where else was I going with that? Venezuela and Argentina. So Argentina is becoming less of a basket case. Venezuela still is. What does he mean here by if the United States takes over Venezuela? Is there some brewing conflict that I'm unaware of, or?
I mean, perhaps you're unaware of the fact that the U.S. Navy is sitting off the coast of Venezuela and has assembled an armada, and there's lots of talk about regime change in Venezuela. We wrote a piece on the day Trump was inaugurated called "Misreading the Room," about how Maduro better not get on any private jets, because he has an armada of super majors next door. And look, the history of strongmen dictators who get on the critical path of impeding oil production is not a glorious one. They often end up dead. Um, not endorsing it, not predicting it, but history does sort of inform on this. And if the U.S. wants to take over Venezuela, it just will. This is the history of the U.S. It might not succeed, but it'll certainly try. Because it's right. Don't forget, Venezuela claims the Guyana oil fields as their own. Like there's a century-old conflict between the two countries about the border, and so. But the potential of what Venezuela can do. We haven't even talked about Mexico yet. We're publishing on Mexico tomorrow on October 7th. A piece called "Tapped Out." I mean, the amount of cartel theft of oil from the national oil company in Mexico, the amount of illicit diesel being smuggled back into the country, masked as lubricants. It's just a real stunning story, and it's in the billions and billions of dollars a year. It's just completely sapping Mexico's ability to produce oil and gas in a profitable way. The national oil company has 100 billion in debt, and All of this, not all, a significant amount of it is just bleeding into the cartels. So when you hear Trump and Hegseth and Rubio talk about the war on cartels, what they're talking about is a war for energy and who profits from it. And so when we read the news, that's what we see.
Okay. No, I was completely unaware that we have an armada sitting outside of Venezuela. Uh, okay, and there could be one coming for Mexico as well when it comes to oil.
Yeah, so much depends on how Scheinbaum does. We note with interest in the piece that Marco Rubio was there, and like very shortly thereafter, 14 people were arrested, including some high-profile power brokers in the country because of this smuggling of diesel into the country, tax-free. The scale that this is occurring, the scale at which this is occurring, Steve, makes it impossible that the very, very high levels of the government are not complicit. We're talking billions and billions of dollars a year. And employees are bribed or intimidated or violence is used. But the cartels and the government have sort of interwoven as basically the country's on the verge of significant challenges. Now, whether they can get out of it and whether Trump helps them get out of it remains to be seen. But this is wildly underreported in the press. So, but not ever a brilliant expose in the Financial Times is how we lead the piece that was published in June of this year. Really a stunning piece. We linked to it in the article. But just the scale of this theft makes Pemex uninvestable. It would shock you. Like we live in a world where we would just assume that corruption and all this stuff is at the periphery, but it's actually at the very core of one of the most important oil and gas resources in the world. Like Mexico has a huge amount of oil and gas, wildly underperforming its potential, as we quote in the piece. Its production is down exactly 50% from its peak, reached in 2004. That's not geology. That's not technology. That's governance, theft, and corruption on a massive, massive scale. And these things have a way of working themselves out. But when we talk about Trump's focusing on the Western Hemisphere, oh my God, I mean, the Western Hemisphere already produces more oil and a ton more gas than the Middle East does combined. Imagine if it got its act together, how much it could do.
Yeah, yeah. Um, while we're on oil, what can you tell us about what happened with the refinery fire down in El Segundo, California, and Chevron?
Yeah, this is a real dangerous situation for California. We've written about this several times. California is an energy crisis waiting to happen. California can best be modeled as two fuel islands. Northern California, i.e., San Francisco, Bay Area, and Southern California, Los Angeles, and related. No pipelines of consequence connect north and south, nor are there any major pipelines that import oil and gas into California. To make matters worse, California, of course, demands a special blend of gasoline for its restrictive environmental rules. And it has like 11 days worth of gasoline in inventory. Now, right, so what happens if, and by the way, refineries have been closing, and I think they're down to like 6 or 7, 3 significant ones in the north and 3 in the south. So this was the largest, or one of the largest in the state and outside of Los Angeles. So all of a sudden you're knocking off a huge amount of supply. Now, it looks like this was an explosion in the jet fuel side of the refinery. I haven't seen credible estimates for damage or repair. They may exist. I just haven't seen them. But I believe I saw that this refinery produces 40% of Southern California's jet fuel. You knock that offline for any significant period of time, and suddenly you're going to have challenges, right? So I don't think anybody listening in Southern California should rush out and fill up their gas tanks in sort of a panic buying situation. But Gavin Newsom, this was predictable. Refineries blow up all the time, right? I mean, it happens. And so if you've got 30 refineries along the coast of, the U.S. Gulf Coast, well, that's one thing. If you have 6 really divided in 2, and one of them goes up like this, could have been much worse from what I'm hearing. But again, I haven't seen any credible damage assessments yet. They're being awfully tight-lipped, I suppose, which is understandable because you don't want to trigger panic in times like this. But this was, well, I mean, as we like to say, the best proof that something was predictable is to have predicted it. And we've written about this situation several times. It was bound to happen. Impossible that it couldn't. You're dealing with explosive liquids and gases under pressure and temperature. And of course, sometimes, a fitting goes bad and, somebody sparks up a cigarette and everything goes boom. Refinery explosions are common, far less than they used to be, but still, unfortunately, quite common. And they were playing Russian roulette. 11 days of inventory. They'd have to rely on imports. Takes a while. By the way, they would have to import their special blend, which would have to be run, right? I mean, so when you actually like just look at it and say, okay, let's game out what happens. One of the refineries in San Francisco sits on a fault that is something like 20, 30 years overdue for a major earthquake. It sits right on it. Right. And so, like, forget about a fire. If I wake up and see a 8 whatever earthquake in San Francisco, the Hayward Fault, I believe it is, I'd be filling up my gas tank if I live there because you're going to run out of fuel. And they've made it so hard for the oil and gas companies to do business there. A very recent about face by Newsom is because of this crisis. Again, in his mind, it can't happen. His objective is that it doesn't happen before the 2028 election, I suppose.
That's his motivation.
But this was very predictable. I mean, we predicted it. It just, anyway, it's frustrating to watch because it takes a crisis for people to wake up to one, and no amount of pointing out the crisis in advance seems to be able to turn the needle.
Yeah. Okay. Okay. So California is an energy crisis waiting to happen. There's no pipeline connecting the north and the south, to connect the dots, the 3 refineries up there and the 3 refineries down here where I'm at. We have no storage to speak of, only 11 days of inventory. And to top it off, California, in their infinite wisdom, takes a special blend of gasoline. If you want to cross over to this side of the border and burn it, you got to get a special one.
Correct. By the way, it's also bad for Arizona because California provides apparently half of Arizona's gasoline, I believe. But these are all numbers that we wrote about last year. I'd have to refresh my memory when I look at the piece. But the broad strokes, as you've articulated, are right.
Okay. Go California.
Yeah.
Embarrassed to say I live here. Okay, let's move on to uranium. So nuclear power. Boulder Minerals wants to know, do you believe now is a good time to invest in either physical uranium or uranium miners?
We would invest in neither, consistent with our belief that the long-term price of all commodities is lower. We would be interested in investing in companies that unleash demand for nuclear power, enabling technologies, much more interesting to us than the commodity itself or the producers of it. That doesn't mean there aren't good investments to be had there. It's just not what we do, and not what we would suggest, just because of our view that there's just so much, just an infinite supply of uranium in the world too. I mean, it all comes down to price. And what's constraining nuclear right now, especially in the U.S., is not uranium itself; it's enrichment. So it's kind of like getting along the refinery and hoping that they have a good 3-to-1 crack spread as opposed to buying oil, because oil is worthless till it gets to a refinery, and uranium is worthless until it's enriched. And so, we would be interested in, obviously the U.S. government has an interest in expanding enrichment in the U.S. because right now Russia has a virtual monopoly over the country in that regard, which is kind of unacceptable. It's not a huge problem. We to a nearest, order of magnitude is probably a $10 billion problem, and that the U.S. military must know how to enrich uranium, and so just a financial issue at this point. But still, investing in uranium itself now is a different proposition than when uranium was $30 a pound and Sprott showed up on the scene. That's all well known and priced in now, and so you're just, if you insisting on owning a commodity, just buy gold.
Okay, so kind of like oil, you see long term these things getting cheaper. If you were forced to invest, that kind of like oil, I'm putting this company in here, but Schlumberger, kind of the guys
Sure.
that are transporting the stuff and dealing with, you need fittings, you need this, you need that. Will be,
Sure.
as volume goes up, this company will make more.
Or
Oh, go ahead.
ET, the midstreamers, those people that make money on volume. Because the demand for hydrocarbons is always higher, volume of hydrocarbon consumption is always growing. And so if you're leveraged to volume and not price, price can be a great tailwind, but volume is your game. That's more interesting to us.
Yeah, yeah. And same way in the uranium play, you might be more interested in, like, looks like there's a choke point right now around enrichment. Find a company that does that.
Sure. Or enables that to happen because they have some special technology or, you know, I'm just making it up for an example.
Yeah. Okay. Okay. All righty. And Blaine kind of puts those two back to back. He says, question for Doomberg. You're at a pitchfork. You got to lock up $1 million of your nest egg for a 5-year period, but you only have the option of which nest to be putting it in. Do you do you allocate this egg to the oil sector, or do you allocate it to the uranium sector?
So sector means I can choose participants within that sector to deploy it against. And I would say it's stone cold guaranteed we're going to be burning more oil in 5 years than we are necessarily going to be consuming uranium. I think there's a bullish case to be made for uranium, but I know that we're going to be burning more oil than we're burning today in 5 years. So I would put it in a subset of companies in the oil sector that are tied to volume.
Okay. There you go, Blaine. Got your answer. And let's see. Energy stocks and company outlooks. Okay, so Alvarez is, we don't really talk about specific companies, but he's basically asking about offshore drilling. Any thoughts?
Yeah, again, offshore drillers themselves produce oil, and so we wouldn't be interested to own them because they're price takers in a deflationary market.
Okay.
But
Okay.
that's no different than natural gas drillers or, and this again is not to be said that fortunes can't be made, especially in the private markets, you know, buying great assets at low prices during troughs and having people overpay for it at some point in a peak. But generally speaking, we're not interested in producers of price taking commodities.
Okay. And Tom wants to know, to just kind of pontificate here, I'm pulling up the VIX chart. We'll put it on a daily here. So this was the awesome moment of Liberation Day when Trump held up his chalkboard, with all the tariffs, made a pile of money on this day. And last, I don't know, few months, it's just kind of looked like a EKG of a corpse. What are your thoughts on the VIX chart?
The VIX is like buying natural gas in Europe. If you pull up Dutch TTF, if you have it, I don't know if you can find it, but
Oh,
LNG in Europe, it's the same chart. So like when you see those spikes, you could fade them, right? Pretty reliably, assuming you don't, go full tilt and actually like naked short something and run out of margin. That's why. So that chart looks to me like the natural gas chart in Europe.
okay. Okay.
And that's why we say like buying commodities, waiting for that spike is just going to crush your premium, especially in gold terms. So much better to say, okay, when the VIX goes above 50, I'm going to try and short it. Now it's hard to do because everyone trades the VIX, and the market makers in the options market aren't really in the business of losing money, and so maybe the premium blows out or you can't get good fills. It's not easy to trade, but you know, uh, trying to time a temper tantrum like this is next to impossible.
Okay. All right. I do have that chart somewhere, but it'd take me too long to
It's
pull it up.
fine. Yeah, it's fine.
I know we brought it up before. Okay. Kai wants to know about Russian refining capacity. Do you still think Russia is winning given its refining capacity destruction?
Yeah, Russia's clearly winning overnight, and yesterday Zelensky was angry at the Western leaders for not doing anything about Russia's devastating strikes against the country's energy sector and demanding a truce in the air. This is not what a winner would be doing. You don't hear similar demands from Russia. Russia's refining capacity has been damaged. Um, Russia exports a fair bit of its refined products, and so the first thing it'll do is limit exports and keep consumption for domestic supply. The strikes on Russia's energy are more likely to motivate Russia to increase its drone and missile attacks and the severity of those attacks than it is to have Russia come to the negotiating table. And I think there's an awful lot of propaganda on this issue. We understand that, but it doesn't change the direction of travel of the war. We note with interest that Russia is allegedly producing 1,000 drones a day, these powerful new drones, and will soon be producing several thousand a day. There's no air defense system that can keep up with this. And about a week ago, Russia has been systematically destroying energy and rail infrastructure across all of Ukraine, 5, 6, 700 drones a night, 40, 50, 60 missiles a night. Patriot, there's a big article in the Financial Times about how the Patriot systems are no longer working against Russia's best missiles. And we're not hearing much about it. I think the political instability we're seeing around Europe is because of this. And so this is a war of attrition. Wars of attrition tend to end suddenly. And we'll see.
Wow, I did not know that. They're making that many drones. This is it's just a matter of time.
Just, well, look, I mean, it's a war of attrition. Which country's bigger? Which country has more resources? Which country produces more energy? Which country has a bigger army? Which country has a long history of marching from east to west and grinding away wars of attrition? The war was lost in December of 2023 when Ukraine's counteroffensive failed. Now, again, a war can be lost and one of the combatants not yet be defeated. There's an important semantics emphasis here. We define a war as lost as one that can't be won. And the war cannot be won conventionally against Russia, and the West has proven that it is unwilling to directly fight Russia or use nuclear weapons. And if I were living in Ukraine or if I were a Ukrainian leader, I'd be very, very angry at the West for putting the country in this position. It is a catastrophic outcome for the people of Ukraine, for the country of Ukraine. I think the wanton destruction of Ukraine's energy systems by Putin is a war crime. I think there's a credible case to be made. Others would say war crime is an oxymoron because all war activities are basically crimes. I'm violently anti-war intellectually. I think we should, the West and the rest of the world should have a very, very high bar towards starting a war, like what's going on in Venezuela right now. It's not legal. There's no justification for what I suspect is going to happen, but it's going to happen. And so when Russia gets its full military-industrial complex grinding, don't forget Russia has not treated this as a war yet. Internally, they call this as a special military operation. They could be going about this in a far different way. There's, I think, 17 major bridges that cross the Dnieper, and if the Russians took those out, they would strand the Ukrainian army on the other side of it, and much of its ability to resupply that army would be knocked out. The Russians have not yet done this for reasons that I don't know. They don't tell me, but they could. And so we'll see. It's a very sad situation. It's a tragic situation. It's a catastrophe. But we have to call it as we see it. We could be wrong. We think we're right. We put it out on the masthead, and if we're wrong, we'll lose subscribers. And if we're right, well, then maybe people will be more likely to believe us the next time we put out something like that. That's the way this business works.
Okay. What's going on right now with France and Macron?
Yeah, we're working on a piece for later this week titled, tentatively titled "Bricks in the Wall." It's not just France. All of Europe is seeing a rightward shift, and Brussels has been trying to stifle that shift. And when you hear Ursula von der Leyen say "our democracy," the emphasis is on "our" and not democracy, their democracy. They stole the election in Romania. Let's call it what it was. Interesting election in Czech Republic over the weekend. Czechs, Trump won the election decisively. Viktor Orban in Hungary. You have Slovakia. Suddenly you have the Hungary, Slovakia, Czech wall. And if you had added Romania to that, and you just look at a map, these are all countries that are, separating Western Europe from Ukraine. And then you have Starmer with 15% approval rating, and Macron with 15% approval rating. And Macron is a failed leader. And France, too, would like to shift to the right, anti-Brussels, anti-war, which is going to cause a panic in Brussels. And honestly, if the war in Ukraine is lost this year, if Putin devastates the entire electricity grid of Ukraine and causing a migration crisis into Europe, and it's very clear that basically the peace terms would amount to a capitulation, that could be the beginning of the end of the European Union. Um, the European Union is wildly unpopular, especially as you go east. Like, and Germany's talking about banning the leading party. Like, this is not democracy. What happened in Romania was not democracy. Um, it just, it's a bad situation. And by the way, energy predicts this. I mean, they've impaled themselves on the energy question for years, and so they've had to deindustrialize. And when you take away the population's potential to improve their livelihood, as we've often said, on the path from abundance to starvation is riot, and the first form of riot is political riot. And if that doesn't change things, then the second form of riot is physical rioting, and we're not quite there yet, but we're closer than one might suspect. And so, I think the entire edifice of the European Union project could collapse as a consequence of the war in Ukraine.
Oh, wow. Okay.
Yeah, we're going to put it in writing. So
Okay.
another bold prediction.
Right on. I like it. That is absolutely what you were known for. Yeah. Do you have any other thoughts? Anything I should have asked that I didn't? Anything in the pipeline?
Yeah, no, I think we've covered most things. I'd like to plug Doomberg.com, of course, where you can find all of our work. But also, I was telling you before we hit record that we've launched a sister publication, completely different from Doomberg, called Classics Read Aloud. There it is. I think you should go ahead and hit the subscribe button live right now, so
Okay, there we go.
we can count you.
Boom.
This is as it sounds. The one of the Doomberg co-founders and its editor-in-chief is very passionate about the classics, and it's produced with the same level of quality and excellence that we pride ourselves on the Doomberg brand. It's the same co-founders that are doing Classics Read Aloud. It's on Substack. Just started it September 1st. Already a couple of thousand subscribers, off to a great start. Steve, always a pleasure to be on your show. Thanks for the opportunity to plug our new project as well as to showcase the Doomberg work. And glad we got that date fixed behind you. Appreciate the mug. Love the green tie. I mean, you're a fantastic friend, and really enjoy your show as well. So thanks for having us on.
Oh, thank you. Yes, I never thought of it, but I guess with the green tie and the mug, I'm a poster child for Doomberg. Doomberg, thank you for coming back on the show. It's always a pleasure.
You bet, buddy.
And thank you for tuning in. Go to stevebartonmoney.com for more, and have a wonderful day.